Your business needs a CFO, and I tell you why. Okay, right before we started this session, Joseph asked me, the master video producer, he said, well, that's going to be expensive. So we said, hey, why don't we start on that? Why don't we start with the cost? He's true, he's correct. It's not cheap to get a CFO. I mean, Microsoft, Apple, all these big companies, they pay millions for their CFO, and deservedly so. I'll tell you why in a few minutes. So yeah, they are expensive. But for your small business, you don't need a full-time CFO. You could just have a CFO that comes in once a month, comes in once a week, and then helps you with the numbers. So one of the things, I guess, okay, so let's go to the beginning now. What's a CFO? CFO stands for Chief Financial Officer. That means this guy is responsible for anything finance related, be it your sale numbers, your expense numbers, your ratios, your analysis. And also what he does, he listens to the company, he listens to the president, he listens to the board, and kind of bring everyone's goals within that, I guess what they talk about in their meetings, bring it with the finances. So, if you want to say we're going to increase sales by 20%, he will keep you accountable for that. So in a small business, there's no difference. Because it's a small business doesn't mean we run things differently. The business is the same. Bigger businesses have bigger manpower, bigger resources, bigger employees or more employees. Small businesses function the same. There's a product, there's a service, whatever there is, and they function. So again, as I explained, what the CFO does, for example, if you read Microsoft financial statements, there will be their president's remarks, and then there will be, the financial statements. All these financial statements, they basically were created or recorded or reviewed by the chief financial officer. So he's the main guy in the business. He makes sure that the numbers are correct, the numbers are represented accurately, the expenses are recorded for. He has a few people that report to him. So for a small business, because you have less layers, the CFO's work could be actually a bit easier. It could be done, better. So one other thing that CFO would do that would basically benefit your business, this is something that probably if you did it on your own, maybe you were not as disciplined. Even myself, I could use a CFO. So what he does, for example, for this company, we want 20% profitability. So the CFO would look, actually that would be his first target. So he will look at the net income, make sure that's 20% of the sales or whatever we wanted for this company to do. Even if you come and say, hey, I think based on our numbers, we should expect a 15% growth. So he'll put in place mechanism to measure the growth of your business. So, sales month by month, quarter by quarter, he will get charts, or he will look at the charts, he will look at the graphs, he will explain. And if the numbers are not going in the direction that the business wants or the small business wants, then they would come and investigate. One of the things that they do, and we learned at school, and I implement for my clients, is we look at comparative financial statements. So what it is, sales numbers or profit numbers from year 1 to year 2. So we'll look at this. We even put ratios. QuickBooks Online, I think you've probably heard I talked about QuickBooks Online. You're probably gonna hear more on QuickBooks Online. This is a must-have for your business. So in it, we could actually say, okay, give us this report, and give us ratios. So when you get the report, when you get the financial statements, let's say 2019, 2020, next to it there would be a percentage of change. That percentage of change tells us the fluctuations from 19 to 20. Any places that this fluctuation has gone up way too much or way too little, we would investigate. And actually something we want to see. For example, we said, okay, we want to increase sales by 20%. So that percentage tells us, if it's 25%, excellent. Basically, it exceeded our expectation. That's fantastic. So we'll go through the next. Some of the ratios we actually wanted to stay the same. For example, rent. 2019, 40 grand, 2020, 40 grand. So for the percentage of change, we want to see 0. But if it comes at 10% or 20%, then we're going to go back and look. Sometimes these ratios are actually related. For example, if you see sale ratios going up by 25%, we would want to see logically that our payroll has gone up, whatever percentages, but has gone up because it means we had to hire more people, or we just increased our prices. So looking at the numbers, we see so much depth in the companies. We can do so many analysis on this company to see the relationship between the numbers, to see if some expenses that have gone up made sense, not made sense, and then we're going to focus on those. And not that we eliminate them, but we find out if those make sense, if that is something that we wanted to do. If it's better, excellent. That's great job. Maybe our prices went up. Maybe the referrals are working. For example, sales went up by 25%. Advertising stayed the same. So that means we didn't have to advertise, and we got more sales coming in. So I guess people are referring our business. So then we want to perhaps come up with more referrals and actually put a bonus for our referrals because it's working. And let's say if we paid $1,000 for advertising and then paid another $1,000 this year, well, maybe we didn't have to pay that advertising because referrals working. So, and actually even better, let's say you were paying 20 grand advertising, 20%, 20,000 advertising here, and then we realized that the revenue did not come from the ads, it came from referral. Maybe we can eliminate that, which actually going to bring me bring you to the next point that I want to talk about. What CFO does, he actually focuses on two places: profit, expenses. So on one hand, we call it profit center, expense center, or cost center. So in the profit center, we want to increase it. So let's say we are making 10 grand, we have 2 services. We can think and say, okay, what other services can we provide which is in line with what we do, and we don't actually have to change our structure and create more income. So if there's any supplementary income that you could generate, that's fantastic. So you could bring to that. And then also cost center. So cost center, we will look at it and say, what can we deduct or what can we reduce or eliminate that it would basically, we don't need it, or we could eliminate it and replace it with something new that basically in our business. So for example, let's say you were doing something that you were paying, $500 for, and then you find out that you could replace this service or this mechanism for $5. So it's like, hey, let's do this. And you want to re-examine most of the things that you do and say, how can I do this better? For example, one of the things that Tesla did, talking about a great business person, when Tesla started working with NASA, one of the things that they realized is that when they send these shuttles up, or these, spaceship rockets, they send them up, one of the expensive parts of that was the rocket fuel. That's 80% of the cost. to basically get this rocket going up in the sky. And I don't know if you've seen the videos or whenever, they shoot it up in the air. I don't know if you've seen what happens to it. It just opens up and the thing drops, and I guess it goes to ocean, it's garbage. So he said, that's 80% of our cost. And then you guys throw in the garbage? Can we reuse this? And I guess all the NASA people, because they're not profit oriented, they're scientists. I guess they're like, well, money comes, so why not? So then he said, if the reason we're not going to space, it's because of the cost, and then we could reduce these costs, so then we can go to space more. So isn't that what we want? So the focus changed. I guess just but one example, he looked at something and it was 80% of the cost. So if you're running a business, something that's costing you 80% of your resources, you definitely want to have a look and say, okay, can I change this 80% to 50%, to 60%? In Tesla's case, I think actually they brought it really down because apparently, this is what I've heard, they're making the structure thinner, so so they can basically pack it with more fuel, and then when it drops, they can find it. Maybe they put a parachute to it. So they saved that piece. So that piece saved, that's 80%. And I don't think these rockets cost like $1,000. So they're probably millions of dollars. So if you save 80% on millions, that's a lot of money. So again, in your business, you can have a look and see, what are these expenses that you could eliminate? At the same time, look at profits. How could we bring more money with what we are doing? We're doing this every day. We add just another revenue stream to it, then we can bring it up. So your CFO can focus on these two and make sure, this is going down, this is going up, without changing the integrity of the business, just making you more profitable. Another thing that he could do, make everybody accountable, put discipline, come up with a budget. So, we can, actually, that's one of the best things to do in any business, even in your own livelihood. Come up with a budget. I remember I did this a long time ago, about 20 years ago. Right away, I think I increased my income by $1,000. So why I say increase my income? Because I reduced my expenses. So when you reduce your expenses, that means you got more money. So, money saved is money earned. So in my case, when I put the budget, I put month by month, and then I say, for example, one of the items on my budget was, that actually wasn't on my budget, but it came up as my expenses, was car repairs. Each month, I didn't even plan for it. I was paying $500 for car repairs. It was something out of my control. Each month I would go to this mechanic, drop the car. Sometimes it's the rat, sometimes it's the ball joint, sometimes it's the, I don't know, whatever. And it was a Volkswagen, so it wasn't a bad car. So it was costing me $500 each month. So then based on that budget, I said, okay, I haven't planned for this, but each month I'm gonna pay this. So if I go buy a brand new car, even at a $200, I would save $300. That's for sure, because it's guaranteed for 4 years. It's a newer car. I get new gadgets, looks good, more comfortable. So I did that. I changed the Volkswagen Golf. The other thing that I did, I used to smoke. And it was costing me about $300 a month. And I needed a bunch of other stuff. I wanted to go to gym. I wanted to get a cell phone. I wanted to get cable. So, and it was basically, it was so clear. Cut this. You can have all whatever you wanted, plus more. So in your business, you could do the same thing. Have a budget, things that you want to spend on the business, things that probably your business needs, or after the investigation you think you're gonna have, and then compare it each month. And this actually could also be done in QuickBooks Online. So you do this, and then you see the fluctuation. So if there's an expense that you earmarked $500 and it came to 700, so you want to investigate that, you want to reduce it. You could even, well, it even gives you discipline. For example, you say, $200 a month for advertising. So if you're going over and it's not giving you any return, so then you would reduce it. Or at the $200 mark, you would stop. So it makes you hold your dollar values accountable. For example, so if you put $200 for advertising and it's not giving you anything, now you want to ask, am I spending in the right place? Should I go to another ad place? Should I use another marketing tactics? So all of a sudden you have accountability coming up. And then actually you're running your business just like Microsoft, just like Apple, just like Google, because this is the practice that they do. They do it on a monthly basis, quarterly basis, could even be weekly basis. And for them, they would have branches. So, Microsoft team on, work on revenues, let's increase it. Microsoft team, on the expense part, reduce. So all these guys would report it to CFO. So the one thing or a few things that I like about this, having a CFO, number one, again, it's not expensive. True. I mean, some CFOs make millions, so you can't afford millions. For a person that would qualify for CFO, let's say a CPA, CGA, or whatnot, somebody that knows accounting or is master in accounting, they're not cheap, but you could afford an hour of their time, and sometimes that's all you need. You don't need a chief financial officer be in the business 24 hours a day. You just need him for an hour. He comes in, he looks at the number, he gets your financial statements, he gets your comparative financial statements. If you don't have it, then I think you should be worried about it, because you need those. Those, again, as I explained in other videos, that's where the pulse of your business is. So you definitely want financial statements, you definitely want budget, you definitely want comparative financial statements. So you would give to the CFO, and he would just look at it. He would get the ratios. You could even print the ratios, say, hey, this is my financial statements, 19-20, or 18-19. These are my ratios. Can we talk about these numbers? And then you explain what your business is, what you're trying to achieve, what you want to be profitable at 20%, 30%, even giving them dollar value. Say, hey Mo, I want to make, I don't know, $150,000 this year. Can you help me? So myself or any CFO, we look at this, and then so whatever you have, that would be our starting point, and this is where you want to go. So then we say, okay, if you do this, you would definitely go from here to there. But then again, if you don't know where you are and, going, I don't know, to another place, I think it would be a little bit hard. Thanks for watching. See you next week.